Hello friends, welcome to my YouTube channel at One Raj Kamal. As you go through this, please do subscribe to the channel and also press the bell icon so that you can get regular updates on future videos as they come in. The last week was a pretty good one for the markets, with the S&P 500 up 2.5%, Nasdaq up 3.3% and Dow Jones up 1.9% as you can see on this chart. And this was in spite of a bad Friday. In fact, on Friday, the S&P 500 went down by 0.87% and Nasdaq even more by 1.87%. So without Friday's bad day, the markets would have had a really upbeat week last week. So that's the news on the overall markets. Crypto markets have shown a similar performance. Bitcoin is up 9.6% in the last 7 days. ETH is up 28.1%. Solana 10.6%. MATIC 22.9%. And Avalanche 26.2%. So broader rallies even in the crypto markets. Now this is a bit strange, and it's important to note that the broader markets seem to have reached a bottom around mid-June and have been rallying ever since, showing higher highs and higher lows. What could be the reason for this? The reality is that the bad news still keeps coming in. In fact, economic conditions seem to have weakened in the last 4 to 6 weeks, not only in the US, but globally as well. And here are some facts to show. First of all, see this chart. Conference Board's leading economic indicator came at minus 0.8% in June, which was the 4th successive month of decline, something unheard of and unseen in many, many years. And the leading economic indicator is actually considered to be a precursor of recession news. Now, see the second chart. This is Philadelphia Fed's manufacturing index, which in July fell to minus 12.3 from minus 3.3, signaling contraction in manufacturing activity. And this was driven by a sharp decline in new orders. A third picture, the US flash services PMI went below 50 to 47 for the first time since the COVID shutdowns of 2020 and the decline in services activity then. And a number below 50 means a contraction in business activity. So US flash services PMI also indicating contraction in services activity. There have been earnings reports that have come out in the last couple of weeks, and the earnings reports of banks actually showed provision for higher loan losses. Why would banks provide for more loan losses unless they were expecting tougher economic conditions and debt repayments becoming a struggle? Some major US companies, notably Microsoft and Apple, have had news around them that they were going to slow down hiring activity. There have also been some real earnings disasters like Snap during this period. And finally, see this picture, 10-year minus 3-month yield, which is considered typically to be the best predictor of recessions and downturns. And this is now at a spread of 28, but more importantly, hurtling down very rapidly. Interestingly, the 10-year is now at 2.75%, down from 3.48% in mid-June. And this is driven by a view that economic conditions are going to be tougher as we go forward. While in contrast, the 3-month is up to 2.44%, the highest in the last several months. And this is in anticipation of a 75 basis points hike that is expected in the Fed funds rate in the next meeting on 27 July. In fact, that's nearly locked in with about 80% probability for a 75 basis points hike in the CME Fed Watch Index. Now, bad news actually has been coming in the rest of the world as well. China's GDP contracted 2.6% in Q2, driven by COVID lockdowns broadly in the economy. In the Eurozone, Germany, the biggest economy in the region, actually has seen contraction in both manufacturing and services activity. See these two charts. The first chart shows German flash manufacturing PMI, which came out at 49.2 in July, and a number below 50 indicates contraction. And see the second chart, German services PMI came out also at 49.2 in July. And both of these signal that the biggest European economy is in trouble. Eurozone CPI is at its highest in 2 decades at 8.6%, as you can see in this chart. This actually prompted the European Central Bank to hike its benchmark rates by 50 basis points, double the anticipated number of 25 basis points. And this is the first rate hike in 11 years. So economic conditions toughening, becoming more dire in the rest of the world as well. So then why are the markets rallying, and why have we had literally a series of higher highs and higher lows since mid of June. Well, there could be three reasons for this. The first is that the market believes that continued bad news will mean that the Fed will see toughening economic conditions as a reason to change their monetary policy stance from being extremely hawkish to being more accommodative. And this narrative, in some ways, is supported by another narrative that July actually saw the peak inflation that we would see for a long, long time. And therefore, the Fed would have more degrees of freedom to go softer on its monetary policy. The second reason is that earnings report actually till now haven't been as much of a disaster as one would expect. Actually, some earnings have turned out to be better than anticipated, notably Netflix and Tesla, where the expectations were very, very bad. Now, as a result, these stocks have rallied in relief, and that has taken the markets forward as well. The third actually is a kind of a contrarian signal that came out when Bank of America came out with its Global Fund Managers Survey, which was based on a survey of fund managers between 8th to 15th July, accounting for about $800 billion in AUM. And this report actually showed that investors were in a state of dire pessimism. In fact, around 80% of the surveyed investors said that they were expecting the economy to weaken in the next year, which was marking the lowest growth expectations since the survey began in 1995. Equity allocations have slumped to levels which are as low as in 2008 during the time of the great financial crisis. And the share of uninvested cash in portfolios is above 6%, which is the highest in 20 years. So it's also possible that the market has seen this kind of an investor report to signal a contrarian view, and therefore, some rally has come as a result of it. So markets could be rallying driven by any of these three factors, or probably a combination of these three factors. Interestingly, what should we look out in the coming week? The next week actually is very important for the market because of two reasons. The first is that it is the week in which the Fed will come up with its next Fed funds rate announcement. We all expect the Fed funds rate to increase by 75 basis points in the July 27th announcement. But more importantly, there will be a press conference and briefing by Jerome Powell. And what he says during that discussion will be extremely significant to where the market is headed in the coming weeks. The second thing to look out for is that the next week is the busiest earnings week in the entire quarterly calendar, with all the majors, Apple, Microsoft, Google, Amazon, Meta, General Motors, McDonald's, Chevron, all of these reporting their Q2 earnings. And what they say in their Q2 earnings on earnings, and much more importantly, their earnings expectations in the coming quarters, will be a very important piece of new information for the market and have a significant impact on where the markets are headed in the short term. My own view continues to be that we probably have seen a kind of a bottom, but I don't expect the markets to keep going up in a V-shaped recovery. I think the markets will roll over a bit and trade, choppy for the next few months. Thank you for joining me today.